Hello, everybody. Welcome to the second quarter 2024 Klaas Financial quarterly webinar. My name is Josh Stirling. I'm the Director of Portfolio Management here at Klaas Financial. Today, I'm joined by Eric Schwartz, one of our advisors, and Kite, our CFO. Today, we'll be going through our webinar. We'll be hitting a couple of key topics today, some of the ones that we typically hit on. The first topic that we're going to go over today is on the markets. Eric's going to lead us in that discussion, talking about what's happened over the first 6 months so far this year. Then we'll kick it back over to me, and I'll have a little bit of a discussion on what's been happening on portfolio so far this year, maybe some of the potential outlooks of what portfolios could look like in the years ahead. Finally, we'll kick it over to Kyle. Kyle's going to have a nice discussion on what's been happening in the economy recently. So before we jump into our webinar today, a bit of housekeeping. Today, you can expect the webinar to last between 20 to 30 minutes. We'll have prepared slides to go through for each of us. And then at the end, we'll have probably about a 5 to 10 minute Q&A session. So as we go through the presentation today, if you have questions that pop up, feel free to use the button at the bottom of your webinar page. It should have a little Q&A button. Go ahead and submit questions to us throughout the entire webinar. We'll take time at the end to answer all those questions. All right, let's go ahead and jump into some of the slides that we have today here. So as a reminder, for those who have been with us for a while, and then for those who are new to Klaas Financial, Klaas Financial is a retirement planning firm. We help families, individuals. We also help corporations and foundations and charities. We help individuals plan for retirement. Corporations, we help them with 401ks. We help foundations and charities use or invest into the markets with all their reserves as well. We've been in the business for about 48 years now. We have about 20 employees, and we help over 1,000 households across America, now over 30 states. It is our goal to help individuals plan for retirement and have success throughout their entire retirement. Now, Eric, let's jump into the topic today. Given that this year's an election year, how has the first 6 months been going?
It's a great question, and one I'm sure everyone can imagine we are fielding a lot in meetings with clients. But the short answer is it's been a great start to the year. In fact, it's been our best start to a presidential election year in 50 years. So 1976, as you can see on the screen here, was just a little bit better. But what we've seen here to start the year is the S&P up just about 15%. Now, that's not to say, as always, not to say that we are not going to see volatility, perhaps increased volatility as we get move into the second half of the year, maybe even as we get closer to the election. But the fact of the matter is, economic growth, especially here in the U.S., continues to surprise. We got another report yesterday showing GDP expanding more than what was expected, and unemployment remains very low. There's a lot going on in the world right now, a lot of which we're going to talk about as we move through our presentation today, but the market has remained pretty steadfast. And I think that the overarching, probably leading factor right now is this hope that we'll still see at least one, maybe two rate cuts by year end. Now, at the beginning of the year, we thought we might see something like 4 or 5 interest rate cuts from the Federal Reserve. But at this point, looks like we're pricing in maybe 1, maybe even 2. So it's, all in all, been a pretty good start to the year.
Yeah, the one thing that I think is really surprising by that 15% number is just how good 2023 was. I think coming into this year, nobody was really predicting equity markets to be double digits returns. It's quite surprising. But I mean, looking at the historical average of the first 6 months since 1940 for election years, being positive is sometimes kind of shocking as well. But it's nice to see that the beginning of this year has been so strong.
Yeah, and we're going to talk a lot more about this as time goes on, but it's just really, we talk to clients about this all the time, separating, it being an election year from what the market actually trades on, right? Which is not necessarily the polls in the presidential race. Let's talk a little bit more, though, about what that we see that broad S&P number, but what's actually in there, what's contributing to that growth. And as you can see on here, a lot of different things. We have 10 of the 11 sectors of the S&P showing positive returns this year. I'll highlight just a couple here. You can see the two biggest factors here are technology and communication services. I think technology is not surprising to anyone, right? It's the AI boom. It's all of the excitement around all these new technologies that has really pushed growth here in the first part of the year. Communication services is a little misleading. You can see it's got really strong performance there. But two stocks in particular, Alphabet, which is the parent company of Google, and Meta, the parent company of Facebook, those are both considered communication services stocks. I think most of us would view those as technology stocks, but within the definition here, they are included in communication services, which you can see is really adding to the push for that sector. And I think one of the other maybe, I don't know if surprising is the right words, but we've seen utilities here first part of the year up 7.6%. They were actually the worst performing sector in the S&P in 2023. So as you can see, broad growth among many of the sectors. Obviously, the magnitude, we're seeing a lot of it in the tech space, but overall, not just tech pushing us forward this year.
Yeah, I feel like it's a slightly different narrative than last year, where last year it was really the Magnificent Seven were the only ones driving the return for the first part of the year, finally getting broad support towards the end of the year. But it's nice to see a bit of support from other sectors so far this year.
Yeah, and those tech and communication services stocks are tough to keep up with when there's hopes of interest rate cuts. Those sectors tend to do pretty well. So
absolutely. All right. Well, let's go ahead and jump into some discussions on portfolios. And we're going to start off the discussion on this part around cash versus bonds. And this is a topic that we've talked about over the last 2 years. And we keep bringing it up because the interest rate environment remains high for quite some time. And it's been really compelling to stick all your excess reserves in cash, or any extra amount that you might have, just stick it in cash because it's earning 5.5%. No big deal. It's totally fine. And it becomes really compelling to just leave that money there when you're earning such a high yield. So sometimes we really have to pause for a second and say, well, why would we invest in anything else other than just letting it sit cash? And we're going to take another pause here real quick. I'm going to say the word cash here probably a few times. All these slides for the next 3 slides here are going to reference cash, but I want to specify that and define that. Cash on these slides are specifically referring to high yield money markets and items like treasury bills, 30-day treasury bills, short-term instruments that are very stable and provide basically the returns that we're seeing today that are called cash, which is about 5 to 5.5. Now, what we're not talking about is bank accounts. Bank accounts, very commonly, checking or common savings, are going to earn you 0 to maybe 1%. Now, some of you might have what are called high yield savings accounts. Those can be a little different, but for the common run-of-the-mill bank accounts, that's not what we're talking about today. That's not where you're earning the 5.5% returns that are coded as cash on these next few slides here. So this chart that we're looking at here, it's looking at situations historically where bonds have outperformed cash in different scenarios and pretty consistently. We're looking at data since 1982, back when inflation was high and interest rates were also quite high. And it's looking at these similar situations that we might be seeing currently or potentially in the near future. So first and foremost, at the top of the slide here, we have the Fed funds rate is greater than inflation. And so the Fed funds rate is what the Federal Reserve comes out and they help define where interest rates should be. And that's generally reflected in short-term cash-like investments like the 30-day T-bills, money market positions, and even some short-term CDs are going to have similar rates to what the Fed funds rate is. So today, you can go out and you can get a short-term interest paying cash-like solution that pays more than what inflation is currently. You could be getting something that's paying 5 to 5.5%, while inflation is sitting down near 3%. And that's something that, while it sounds really interesting and really compelling right now, you can get something that's near risk-free, that's beating inflation and earning you interest above and beyond that. You have to ask yourself, well, how long is that going to be true? Because to be quite frank, this doesn't happen very often. Looking back over the past 20, 30 years, you'll see this happen every once in a while where interest rates will bump up above inflation where it's near risk-free, but it doesn't happen very long. Now, the unusual circumstance we're in today is that we have seen it for quite a bit of time. So it does lead into being a little bit more compelling. The compellingness of staying in cash longer. However, when we historically have seen the Fed funds rate beat inflation, on average over the following 12 months, towards the right here on the screen, we can see that cash typically stays around that 5.1%, where bonds return 7.5%. And now that's because bonds, and this is a diversified bond portfolio, something that has government bonds, corporate bonds, maybe a little bit of high yield, maybe more mortgage-backed securities, items like that. They typically carry a little bit more risk on credit, a little bit longer duration bonds, but they're going to provide better return over longer periods of time. That's something we're going to come back to a few times in the next couple of slides here. But historically speaking, cash, at least in the short term, offers a pretty good yield, but it might not last forever. Where bonds, we are going to get hopefully a higher return, and we'll be able to sustain that higher return for much longer over time. Now, the second piece on here is one that we haven't seen yet. It's rumored, maybe, when the Fed starts lowering rates. So the Fed, like the title says, appears ready to cut interest rates. Like Eric said, it seemed like they were poised to have 4 interest rate cuts at the beginning of the year. Now the market is pricing in 2. We'll see what actually happens there. When we eventually get to an interest rate cut, history shows that cash starts lowering returns. And that makes sense, because if the Fed comes in and lowers rates, well, they're lowering that instrument altogether. They're lowering the Fed funds rate. The Fed funds rate directly impacts money markets, what they're yielding. It impacts CDs, what they're yielding. It impacts all these things that are just simple and easy to use. And that's why bonds are something outside of that. Of course, the Fed funds rate cutting or lowering, that's absolutely impacted. But it's not as correlated as cash is to what the Fed does. In addition to that, bonds are going to, of course, have higher yields and what's called spreads. They typically earn a little bit more than what Treasury positions are earning or the Fed funds rate is earning. But because they're longer dated than just 30 days or 90 days, you're going to be earning a little bit more interest in that as well. The third and final one on here is the yield curve normalizes. Now, a few of you might know what the yield curve means, but for those who don't know what the yield curve is, essentially bonds out there, let's use treasuries for instance. There are 3-month treasuries, 1-year treasuries, 5-year, 10-year, 20-year, 30-year, and a bunch of different parameters in between. Now, all of those different dated treasury positions all give different interest rates. Now, historically speaking, in a normal market, if I'm going to give my money to the US government and they're going to give me a treasury note back, I'm going to want a higher interest rate the longer it is. So if I'm going to give up my money for 30 years and treasury at 5 years is paying 4%, I'm going to want more than 4% to make up for how long I'm giving my money away. Now, today, that is not the case. Right now, short-term bonds are paying much higher, or I say much higher, we're talking about maybe 1%, depending on where it is on the curve. but you're getting higher rates for being invested over a shorter period of time. Now, this is a very odd situation. It doesn't happen very often, but when it happens, it can be a little interesting on the approach to take for portfolio management and for where you should be putting your money. Now, this does normalize over time, and that can happen from a multitude of instances. The most common one we're going to hear about in the next maybe 6, 12, 24 months is as the Fed starts lowering rates. As you start lowering rates on the short end of the curve, hopefully that begins to normalize as expectations for where interest rates might be in the future start to become more in line with what expectations are today. And as those situations happen, the yield curve normalizes from its inverted status. History shows that, again, a diversified bond portfolio is going to outpace cash.
Let me pause here for a second, Josh, because this
Mhm.
is a really tons of good information here, but this is a pretty complicated slide. So let's just kind of review, beginning to end here. So again, not making predictions, but bonds tend to outperform cash when one, the Fed funds rate is greater than inflation, and at this point, greater than inflation. Two, the Fed starts lowering rates. Fed appears ready to lower interest rates, and the yield curve normalizes. So we're sort of in the process of that right now. So to me, that's 3 for 3.
Yeah, absolutely
Who
going to
knows?
happen.
We'll see what's going to happen. We'll see what's going to happen. But
all right. Well, now you might be looking at this and saying, well, I'm either not invested in all bonds, or if I were to take, let's say, I have a bunch of cash on the side, it's well above my emergency reserve and I need to put it to use. Maybe just a bond portfolio isn't what's appropriate for everybody. And so let's take a look at a diversified portfolio. We're going to look at the 60-40 portfolio, which is simply 60% equities, 40% bonds, all diversified. It's our most popular portfolio that we use for retirees as they're looking for stability yet growth throughout retirement. So what we're looking at here on the screen is the likelihood of cash outperforming a diversified portfolio. And so the chart that we're looking at here is showing different time frames since 1957. And what it's doing is it's looking at 1 year, 2 year, 5 year, all the way up to 20-year time periods from 1957 to today. And so what it's essentially doing is it's looking at 1957 to 1958. Okay, did cash beat or did a 60-40 portfolio beat? Then it's looking at the next year and looking at which one beat the next year. And it does that for the 1 year time periods. Then it looks at it for the 2 year time periods, the 5 year, and so on and so forth. And so when you spread out the time horizon or the length of time that you're looking to invest the money, the much lower likelihood that cash actually outperforms a diversified portfolio. Now, I do have to say here, even though the chart shows quite high on the left-hand side, that's still 29% of the time cash outperforming a diversified portfolio. That's less than a third. And that can even just be simply in markets where 1 year it goes down 20% and then shoots right back up the next year. So a 60-40 portfolio, I mean, historically, with all the clients that we work with, we don't recommend clients to be invested into a 60-40 portfolio if they're looking to liquidate it in 1 year.
No.
And that's why it's so important to look at these longer time horizons where 10 years, only 8.5% of the time cash beat out a 60-40 portfolio. You have a much more likely scenario of a 60-40 portfolio producing really strong returns for you compared to just leaving into a high yield money market position.
And we
I love
just
this.
we just had this last year, which is what's so important, right? Like, because we all finished out 2022 was a miserable year, so everybody was running to a 5% CD in the first part of 2023. But now you look back on what the 60-40 did over the calendar year 2023, and it was significantly higher than 5%, right? So that's why we always say hindsight is 2020, and knowing exactly when to get in and get out of the market is a losing game, which is why we don't invest that way. But like I said, last year was just a perfect representation of what this is illustrating. So
Yeah, I'd even say so far this year, 15.3% in the equity market, I guess. But
Well, I love this graph because this, for all of our clients listening, this is why we are always asking you when you say, hey, what should I do with this extra money I have? We're always asking, what is the money for, right? What are you going to use this for? Is it retirement money? Is it for a new car? Is it for, buying a larger house? Whatever it might be. I think sometimes people are like, well, I don't know, I just want to invest the money. But if we understand what we're investing for, you can see we understand what the timeline looks like to actually distribute those funds. And this graph is a perfect example of understanding your timeline and knowing whether it's a good idea to invest or be more conservative.
All right. Well, this is only half of the piece of it, because let's be quite frank, the cash and the difference between cash and a 60-40 portfolio in terms of returns aren't really the same. This is looking at true and false. Did cash outperform a 60-40 portfolio or not? Let's look at the significance of what happens when a cash does not outperform a 60-40 portfolio. And that is this slide right here. So in situations when cash does not outperform a diversified portfolio, let's look at this slide instead as the opportunity that has been lost from not investing in that 60-40 portfolio. So you can see here in the first 1 or 2 year scenarios that are on the slide, it's, a decent amount. I wouldn't balk at 6.1% or 12.7%. But again, those longer time horizons, if you're sitting on cash not being invested in the market over a 10-year time frame or a 15-year time frame, that's when some of the core components of the benefits of being in a 60-40 portfolio really start to bite in and really create the pain there. You're getting growth from equities, you're getting income from your fixed income or dividend generating equities. And those really impact in the compounding nature of investing. And so, yes, the cash or money market positions can produce yield that can also have compounding investments. But when you bring in equities into the game and you bring in a diversified bond portfolio, it's dramatic the difference it can make over a long, long time horizon. Right. So, Kyle, let's talk a little bit about what's happening in the economy.
yeah, absolutely. So this chart right here is roughly 4.5 years or so is all we're looking at here. This is percentage change in household net worth year over year. So this is why, for those of you that work with us, that we track net worth of all of our clients on a regular basis. This is why we meet with you on a regular basis to see what's changed and all those types of things. For those of you that don't track your net worth, you definitely should be tracking it. So what you'll notice is going from left to right here, from 2019, it was going up. We had COVID, obviously 19 into 20, drove it down. And then from 2020 to 2021, we had a spike, which was primarily driven due to, we had a really good stock market year in 2020, but we also had house values exploding. And then you'll notice that it came down in 2022. Well, house values pretty much have held steady from where they were back at the end of 2020, 2021. That was the big drawdown in the stock market. So you'll notice there by the end of last year, or end of 2022, it actually dipped down about 4%. To where now we've seen a rebound. So this rebound here, it's up basically 9% over the last 4.5 years, is due again primarily to home equity growing, because obviously the value went up, but people didn't necessarily take out bigger mortgages or anything like that on existing homes. But also the stock market has had a really, really good run. So you got to be careful. Some people they don't focus on net worth because, again, it takes into your house and your cars and all that kind of stuff. And most people don't view those as like ready to use assets. So most people follow what we call investable net worth or investable assets, meaning your portfolio, your cash, that kind of stuff. So even in the last, like we've said, the last half a year, even that has gone up pretty significantly with the run up in the market through 2023. And then obviously the great start that we're talking about here. So it's really interesting to see this. And this is why they're saying, you know, consumers are resilient and consumers are in great shape, because there's a lot of home equity on the sidelines that isn't being used right now and all those types of things. So the consumer is still in pretty good shape at this point. And that's why a lot of people are continue to spending, because when you see that you're, you know, a lot of people, even working people, your 401k goes up, you feel like you have more money. So you might spend out that extra dinner out or take that extra trip just because you feel like you're richer because of the value of your assets going up, honestly.
I mean, this is the interesting part of conflicting data that's out there, because if you were just looking at consumer sentiment, you might not imagine that this graph is really telling the truth. But from all the aspects that you talked about, Kyle, I mean, the consumer, from a net worth standpoint, and really that home equity is driving a lot of it. The stock market's driving a lot of it. Are in a really strong position still, which is surprising, as you've been hearing just how consumer sentiment has continued to decline over the past couple of months.
Mm-hmm. All right, so we've talked a lot about the rate cut, and if the Fed is in fact going to cut rates, what do they need to see for that to be a thing, and why is the market, you know, betting that there will be some rate cuts later on in this year probably? So for what the market is betting on, for those of you that pay attention to this kind of stuff, the market is saying there's about a 90% chance that the Fed does nothing next week when they meet for their meeting, meaning they're not going to cut rates, they're not going to do anything like that. What the market is thinking that they will do is kind of soften their language to set themselves up for a September rate cut, essentially. So this is going to be like a transition meeting where they go from higher for longer to a softer stance, and that they may see some coming. So all along, the Fed has been saying that they are data dependent. So some of the data that they look at is obviously core inflation. So that is, like, it depends on how you view this, but core inflation right now is just below 3%. It's not quite down to their 2% target, but it's certainly trending in that direction. And I think we showed their scatter plot last time, where they think that they will hit 2% maybe in 2025 or 2026. So that's an interesting thing to look at. But we've also harped on the core inflation X shelter. So taking out the housing cost, rent cost, that stuff. That inflation reading has been negative for 2 months in a row. And so this is the first time that's happened since the pandemic, which again, that's kind of one of those one-off things that you can't really put a ton of stock into. But before this, it was 10 years ago in 2014, where core inflation has actually been negative for 2 months in a row. So this is probably one of the biggest kind of data points that the market looks at and says, you know what, maybe this is kind of the icing on the cake, that maybe they can start moving towards a cut at some point here. But it's important to notice that just because they begin to cut rates doesn't mean we're going back down to zero, right? It's going to be, what is the new normal that we're going to have? Is that the Fed funds rate right now, like we said, is between 5.25, 5.5. Does that mean that the Fed funds rate goes down to 4% or 3%? That's still up in the air, and that's what nobody really knows the true answer to that. Many people remember, you know, the 1990s when mortgages were 6 and 7%, and we just had an economy that was on fire. So it seems like, you know, that's mortgages right now are in that 7% range. That might be a little bit too high because the housing market is locked up. But if they cut that down to where mortgages are 6 or 5.5, that might be a reason for people to either sell their home because they've locked in a 3% mortgage and they don't want to go up to a new 6%, but maybe they're okay going to 5 because they want that bigger house or whatever it is. Or honestly, we were just talking about this, maybe that's the rate that unlocks some of the home equity that's on the sidelines, is that they don't want to pay 6% or 7% interest on a home equity loan, but if they're paying 4 or 5 on a home equity loan, that may be a reason to get them to use some of the money that's on the sidelines. So again, it's not that they're guaranteed to cut. The market has been very poor at predicting what they do with interest rates, honestly. But it does look like the data is starting to show that this could be a time to start easing it at some point here.
I think if the market was right, we'd be in negative territory.
You know. All right. And so this was our second quarter, obviously, quarterly recap, but we had some pretty big news not long after the second quarter ended. So this is just showing the two kind of biggest news stories that we've had over the week and a half here. So obviously we had an assassination attempt on a presidential nominee. You'll notice that the market didn't really move much. That blue line is the S&P 500. The orange line is the Barclays bond aggregate. So the market really didn't do much there. And then when Biden stepped down here just in the last few days, again, the market was pretty much agnostic to that as well. So the reason that we put this chart in here is just to show that the market doesn't necessarily have correlations with what's going on in the political landscape. As you've heard us say before, the stock market is pretty much agnostic to who's in the presidential office for the most part. So yes, headlines definitely change things, but it's not necessarily the political headlines that are going to make the market move. It's going to be more economic or, data-driven things that's going to make the market move than just political headlines at this point. That being said, historically, we'll talk about this in our next quarterly meeting. October is one of the most volatile months of the year. It is the most volatile month, actually. And with us being that close to the election, there's a very good chance that we're going to have some volatility come October. So
I think we chatted about it. We all decided that we're going to try and predict the election.
Yeah. No, I think we just really focus on this though, because we tend to talk a lot about, the sort of separation of especially the political world and the markets to some extent, because this is something that everybody can get wrapped up in really easily. And it's an emotional topic for a lot of people, but it's, again, one of those moments where we, as a firm, want to help train our clients to try and separate, because emotional decisions related to your investments generally are not good decisions. So we want to just kind of stick to the fundamentals of how we approach investing. And so that's why we like to revisit these topics when we're in a year like now.
Right. Perfect. Well, those are all of our paired slides here. So we'll go ahead and we'll move over to some of our Q&A that we have. Go ahead and pull this up. And if you have any questions that you'd like to ask, feel free to go ahead and enter those in now. We have just a little bit of time to answer a few questions here. All right, so the first question that we have here, how long will banks continue to pay higher interest rates on CDs? It's a good question, something that we chatted about a little bit today.
Really good question.
It is a good question. Yeah, so CD rates, what banks choose to give interest on CD rates and savings accounts and all that is highly tied to that federal funds rate. So it's very likely that if the Fed were to start cutting rates, CD rates are going to go down along with them. That being said, there is a caveat that if a bank is looking to lend out a lot more money, you still might find CD specials and things like that because they're trying to increase their reserves to be able to lend more money out. But if the Fed actually cuts interest rates here over the next however many months, you will likely see CD rates go down to closer to the Fed funds rate, honestly.
Great. Next question we have here is another good one. So what investment strategy changes happened at the end of May this year? So great question. Back in May, we executed on a handful of trades that impacted a number of accounts across our clients' accounts. The reason that we have this is because we're actively monitoring our clients' accounts consistently over time. And one of the things that we have to monitor for and watch for is that our clients remain in an allocation that we want them to be in. We monitor for drifts outside of that. So if a portfolio was invested in, say, the S&P 500, and we wanted it to be at 20%, and it grew up to 30, 40%, well, we need to bring that back to target. And so those are some of the things that we actively monitor and we watch for over time. And so back in May, we went ahead and we executed on trades that brought a handful a decent amount of our book back into targets, just because at the end of 2023, beginning of 2024, had some movements across the board, and we wanted to make sure that clients' accounts are in alignment with the portfolio design that we intended to have. So these are normal trades that you'll see over time. Back in May, they were a little bit larger than normal that you might see on a monthly basis, quarterly basis. But these are things that we're actively monitoring all the time. And we'll go ahead and take care of that for clients. That's what you pay us for, is to monitor these and execute when they need to be executed on.
I think one of the other things that I mean, I've been hearing from clients, and Josh, we've talked about as well, is clients are seeing some new funds in on their statements for the first time. So it seems like we swapped out some of the investments that we're using as well.
Yeah, absolutely. So occasionally you look at some of the investments that we're invested in currently, and sometimes the investments underneath those what we call ETFs or mutual funds, the investment vehicle that we use to invest in stocks and bonds, change or are no longer hitting the kind of allocation that we're looking for. And so as needed, we'll go ahead and we'll swap those out for another one that does exactly what we're looking for. Other things that happen is new investments come out that are a better opportunity than what we had before. So we're always searching the marketplace for the best solutions possible for people. And as a matter of fact, during this rebalance that we had, some of the new funds that we brought in, we're actually able to reduce our internal expenses on portfolios while actually increasing diversification. And some of them were from brand new products that didn't exist 2 or 3 years ago. Now, these are from reputable firms that we utilize, JP Morgan, Dimensional Fund Advisors as well, are two of the names that I can throw out there that are exact examples of those scenarios that we brought in. But it's making sure that we can bring in new investments that achieve the goals that we're looking for, lower cost, and are all around just great options to bring into the portfolio. So, yeah, good point.
I'm gonna ask one more question. I'm kind of grilling
Yeah.
Josh here because
Go for
we're
it.
talking to clients about this all the time. But one of the changes that was made in the portfolios is removing the direct real estate investment that we had in there.
Yeah.
And I've had a lot of questions from clients about, is that Klaas saying we don't want to be invested in real estate, or what does that look like?
Yeah, another really good question. Real estate is something that's available within public markets, which might not typically be something that you think about right off the bat. You think about real estate as just investing in your home or investing in what used to be called illiquid REITs or real estate investment trusts. There are many different vehicles to investing in real estate, but there's a big swath of real estate investments that are publicly traded just like a stock. And so these can either be invested in directly through what we used to be in, which was REIT, iShares Global Real Estate Investment Trust, which is public, liquid, and invested directly in real estate. But that doesn't mean that all of our other investments don't actually have real estate underneath them as well. So when we go in and we rebalance a portfolio, if we just looked at one thing and said, I like this, let's go ahead and put it in, and we didn't look at anything else, well, you could all of a sudden start duplicating investments. You could all of a sudden have way more exposure to something that you don't want. So this rebalancing that we did, we analyzed it and found out that we already have enough real estate in the portfolio as we're making these changes. There's no longer a need to have that real estate exposure directly invested in the portfolio. So by doing this, again, you're reducing expenses, you're hitting the diversification points that you need, and you're doing it in a way that simplifies the overall portfolio. So we are absolutely still invested in the real estate markets from a public perspective. That's very critical to the portfolio and something that we're monitoring actively all the time. Yeah, really good question. Keep them coming. All right. Here is another good one as well. Markets have been up and down over the past few days. GDP came out strong today. Why didn't the market react more positively?
It's a great question. So as you guys probably know, the market is big on expectations. And yes, it came out hotter than expected, but not by very much. I think it was like 0.1% or something like that, higher than what was expected. So that's part of it. And then the other part of it is just that the market, that while it's good, it could also be a reason that the Fed holds rates steady, because that's just one more strong data point that they might not be ready to cut yet. And right now the market is really focused on when are these rate cuts going to come and what are they going to look like more than anything.
So it can't be too good Maybe too bad. You're right there in the middle. Hit that perfectly.
I call it the
But,
Goldilocks, right? Not too hot, not too cold.
I think also, I mean, to be quite honest, yesterday was a pretty brutal day in the markets.
Yeah.
It was the worst day since 2022. And unfortunately, the markets look really good today. And I was really excited to talk about how, oh, don't worry, it bounced right back the very next day. Unfortunately, markets closed in the red again today. We should hopefully see better markets in the near future. But that being said, like Kyle said, it's about expectations and what the market's expecting. A lot of the red in the market had to do with kind of the Mag 7 having a lot of reports come out on earnings that just weren't hitting expectations. So you had some of those big names come out, give lackluster reports. The market reacted accordingly to that, which unfortunately is a bit of a driver in the stock market. But that's why we're excited to see broad market returns over the year-to-date timeframes being so supportive that we're not just relying on just the Mag 7 to generate all the returns. All right. Last question that we have here before we run up on time. What is the minimum amount of time in years that I should have available to leave money alone to justify equity investment risk exposure?
This is a really good question, and I think very much going to have a lot of personal opinion in it. So Kyle, you may have a different opinion on this than I do. My short answer to this question, I usually give really long answers. I would say 3 to 5 years.
I would agree. I would say 2 to 5, but yeah, same range. Yeah.
I'm gonna go even further and be more vague and say it depends.
I just gave a succinct answer. We need to stay on.
No,
And honestly, so the reason we say that is because if you look over the history of the market, the probability that it's up over a 3-year time frame is what, 80-90%, something like that. I forget the exact number. Whereas over a 1-year time frame, that number gets cut down pretty significantly. So the last thing you want to do is invest money that you're going to use for a big purchase. Let's say this is your housing down payment and you got $100,000 that you want to put into the market, but you're not buying a house for a year. And in a year that the market goes down 10%. So now your 100,000 down payment is now down to 90,000. So where are you going to come up with that extra 10,000, right? Whereas over a 3-year time frame, we're pretty confident that it's going to be higher than when you put it in, just based on, again, historical market trends and things like that. So,
all right, perfect. Thank you, Kyle. All right. Well, that's all the time that we have today. Thank you very much, everybody, for joining us today. We will see you as we're butting up right next to the elections here in a couple of months. Thank you so much.
Thanks, everybody.